What is better, term or whole life insurance? Term and whole life insurance, two of the oldest forms of life insurance, continue to be among the most popular. Whole life insurance is a kind of permanent life insurance that covers you for the remainder of your life years. On the other hand, term insurance is limited to a certain number of years and does not accumulate cash value. Returning to the fundamentals, what is the difference between term and whole life insurance? And which is better suited to your needs? We'll break down the major characteristics that set these two insurance titans apart. Term insurance. Term life insurance is likely the simplest to comprehend, since it is simply insurance devoid of frills and flourishes. The sole purpose to get term insurance is to ensure that your beneficiary will receive a death benefit if you die while the policy is in place. As the name implies, this simplified kind of insurance is only valid for a certain length of time. It can be 5 years, 20 years, or 30 years. After then, the policy becomes null and void. Benefits. Due to these two characteristics, simplicity and fixed duration, term plans are also the least expensive, often by a significant margin. If all you want from a life insurance policy is to safeguard your family in the event of your death, term insurance is probably the best option. Due to the fact that term plans are often less expensive and may continue until your kid reaches maturity, they may be a possibility for single parents seeking an extra safety net. Affordable. Allowing you to choose the term of your policy ensures that you pay for exactly the coverage you need. Additionally, you have consistent rates throughout time. This kind of insurance is economical since it is purchased for the years that you need it, such as when raising a family or paying off a mortgage. Individuals frequently purchase this form of just-in-case insurance due to its affordability. Flexible. With term life insurance, you may customize your policy to meet your specific requirements. Customization possibilities include the quantity of coverage, the duration of the policy, and even riders if you want more protection. Simple. Term life insurance plans are simple to comprehend due to their flat rates and defined term durations. Once you've locked in a premium, it will remain constant for the duration of the term, even if you acquire a health problem later. Drawbacks. Naturally, a multitude of things will affect their pricing. For instance, a higher death benefit or a longer period of coverage will almost surely result in an increase in premiums. Additionally, since the majority of plans involve a medical check, any health difficulties may result in your premiums being higher than average. Because term insurance policies ultimately expire, you may realize that you spent all that money on little more than peace of mind. Additionally, you cannot utilize your term insurance investment to accumulate wealth or defer taxes. Expiration. A term life insurance policy may offer protection for decades, but the policy will ultimately expire. That is why, even if they are initially the least expensive option, they can end up costing significantly more. Whole life insurance provides protection for the rest of one's life, while term life insurance does not. No cash value. Unlike whole life insurance, term plans do not accrue extra cash value that may be used. Many individuals, however, choose a less expensive term insurance coverage and invest the difference. In this way, they continue to accumulate assets over time. Whole life insurance. Whole life insurance is a kind of permanent life insurance that varies significantly from term insurance in two respects. For one thing, it never expires as long as you continue to pay your premiums. Additionally to the death benefit, it gives some cash value, which may be used to meet future expenses. Benefits. The majority of whole life plans are level premium, which means that you pay the same monthly premium throughout the policy's length. These premiums are divided into two categories. A portion of your contribution goes toward the insurance component, while the remainder contributes to the growth of your cash worth over time. While many carriers provide a guaranteed interest rate, other organizations sell participating plans. They give unguaranteed dividends that might boost your overall return. Initially, the whole life premium is more than the cost of the insurance. However, as you age, this trend reverses. The cost becomes comparable to that of standard term coverage for someone your age. This is referred to as front-loading your insurance coverage. You may subsequently borrow or withdraw funds from your cash value account, which grows tax-deferred, to cover costs. In that regard, it is a much more adaptable financial instrument than term insurance. Loans from your insurance are tax-free, but any investment profits on withdrawals are subject to income tax. Coverage. Whole life insurance never expires or requires renewal, making it a solid solution for anybody with long-term financial obligations. You may want the peace of mind that comes with this kind of coverage. Cash value. This sort of coverage may help you amass cash value that you can draw against in the form of a cash loan to cover any last costs. You may use the cash value for any purpose, such as medical expenditures or relocation to a retirement community. Fixed premium. Generally, whole life insurance plans have a set premium rate. Knowing your rate in advance might assist you in arranging how to pay for your coverage. Drawbacks. Regrettably, the death benefit and monetary value are not entirely distinct aspects. If you take a loan against your policy and do not repay it, your death benefit will be reduced by the amount borrowed. If you take out a $50,000 loan, for example, your beneficiaries will get $50,000 less, plus any accrued interest. Expensive. The primary downside of whole life insurance is that it is much more costly than term insurance. Permanent plans often cost between 5 and 15 times as much as term insurance with the same death benefit. For many customers, the comparatively high cost makes it difficult to stay current on payments. Insurance coverage is more than necessary. Another disadvantage of whole life insurance is its inherent complexity. For example, with a term policy, you may simply cease making payments if you no longer need the insurance or cannot afford it. However, depending on the carrier, whole life policyholders may be subject to a surrender fee of up to 10% of the policy's cash value if they choose to cancel the policy. Typically, this charge diminishes over time until it eventually vanishes. Is a term life insurance policy better than a whole life insurance policy? This is a time-honored question in the life insurance industry. The answer is that it depends on your specific requirements and desires. If you need life insurance for a very little period of time, term insurance may be preferable due to the lower costs. If you want permanent coverage that will last the whole of your life, whole life is likely to be preferable. Additionally, whole life provides several living advantages as a result of its cash value accumulation, which lowers its real cost over time. Conclusion. With its cash value component, whole life insurance surely provides more financial freedom. Nonetheless, since permanent plans are more complicated and costly, many buyers adhere to the age-old adage, buy term and invest the remainder.